Hello everyone, welcome to another session of our Fund Manager series. Today we have Mr. Ankit Singhania. He is the head of passive strategy at UTI Mutual Fund. He is a qualified chartered accountant. He has over 14 years experience largely on managing passive and hybrid strategies. Prior to UTI, he has worked with AMCs like HDFC and Nippon Mutual Fund as passive product specialist. Thank you, Ankit, for joining in us today and addressing our audience.
Thank you.
So my first question is on the passive strategies, which is relatively less understood in the Indian market. And you, as an AMC UTI, manage a large portfolio of passive funds. How does passive strategies differ from active investing?
Now, if you see from a construct perspective, the major difference between an active and passive is that in case of actively managed strategy, the expectation is that an active strategy will generate alpha, which is return over and above the broad index or the benchmark index, where the portfolio construction is largely discretionary, which means a fund manager, basis his understanding of the market, will create a story around that market, build a portfolio around that story, and ultimately that story will lead to that alpha. So the advantage is that it is an alpha generating strategy. The challenge is that it is discretionary in nature. So sometimes that story might work, sometimes it may not work. So ultimately the consistency of performance is an issue. When it comes to passive, passive is simply that there is no discretion that is being applied. In case of passive, what we do is that we take an index which is already created by the index provider, say by NSE or BSE, and we simply try to replicate that index with the objective to deliver performance as good as what index delivers. So there is no discretion that is being applied there. And the objective is that we try to play on the collective wisdom of the market. Right. So the advantage is that there is no discretion that is being applied, but the challenge is that you cannot expect any kind of alpha from those strategies, right? For example, if I'm replicating a Nifty 50 in the form of a Nifty 50 index fund, you cannot expect that I should generate alpha over Nifty 50 because that's not possible. So that is the major difference between active and passive. Now, having said that, if you see, there is a new category within the passive that has been evolved, which is called the smart beta or factor based strategies. That is actually a combination between active and passive. Now, when I say active and passive, the advantage that it takes from active is that they are also alpha generation or alpha generating strategy, in the sense that they also have a tendency to outperform the broad indices like Nifty 50 or Nifty 100 or Nifty 500. And at the same time, they also does not allow any discretion to be applied on them. It is simply a rule-based defined method of stock selection that is being monitored, implemented by the index provider, and we are simply replicating it. So that's called the smart beta strategy.
Right, and I'm glad that you came onto the smart beta strategy, because my next question was on to them only. And so it's a new concept and now coming up in India. And we have seen different factor based strategies. There are different factors like momentum, quality, growth, low volatility. And we have seen among these all factors, momentum being the most consistent factor and generated alpha.
Correct.
And not just in India, but across the globe. So how do you explain momentum to a general audience?
Right.
What is this momentum and how do you look at this factor?
Sure. Now, as I said, that if you see all these factor-based strategies, the objective of them is to outperform the broad index, right? The way they are constructed, the way they are defined, the way they are formulated is only to kind of create a portfolio which have a tendency to outperform the broad index. Now, particularly to momentum, if we talk about momentum, what it does is that momentum philosophy says that the stocks or the part of the market which have done well in the recent past will also continue to do well in the recent future. Basically, you try to capture the current momentum of the market. That's what momentum strategy does for you. It actually considers the performance of last 6 months, consider the performance of last 12 months, so the near and little far kind of track record, 6 months and 12 months, and then assigns equal weight to 6 months and 12 months to identify the momentum using the standard deviation that these part of markets have created over a last 1 year. So simply put together, it sees the current market environment in past 6 months, also a little far market environment in last 12 months, and accordingly assigns a momentum score to all the stocks in the universe. Let me kind of give you through an example that if we talk an index like a Nifty 200 Momentum 30 index, where the universe is Nifty 200, which is first 100 stocks from large cap and 100 stocks from mid cap. Within that 200 stock, the first filter that it applies is that the stocks which are part of FNO will only be considered. So that actually gives a lot of comfort, because ultimately the liquidity of the underlying stocks will never be a challenge. Now moving to the next leg, if we see out of the selected stocks, which is those who qualify that FNO criteria, what it does, it applies the momentum score to all the stocks using last 6 months returns, last 12 months return, and standard deviation for last 12 months. Then it assigns a momentum score in the form of Z score and then ranks all the stock. And the stocks which form the first 30 in terms of the ranking forms the part of portfolio. Now, with that strategy, you have actually so far only selected the stocks which will be part of your portfolio. The next step is to assign weight to all these stocks, where weights are assigned on the basis of their momentum score as well as free float market cap. Again, that liquidity part is taken care of.
Right.
And again, there are two conditions that is being applied on the weighing alignment is that none of the stock will have a weight of more than 5%. So you're also getting a stock level diversification.
Right.
Right. So there are a lot of cushions that has been provided in building the overall strategy in terms of portfolio construction, so that it gives you a diversified exposure. At the same time, it also meets its essence of delivering the kind of return that momentum kind of strategy is expected to deliver. And if you see from an index perspective, the index once constructed, it is also being reviewed and rebalanced semi-annually, which is in the month of June and December. And every time that same exercise is being followed by the index provider. And if what we have seen historically, that momentum kind of a strategy on a 6 months, every 6 months, out of 30, almost like 15 stocks move in and 15 stocks move out. Which means on an annualized basis, this index has a portfolio turnover ratio of around 100%. Now, this was all about the construction of the index. Now, with all these jargons that we talked about, what is the outcome? Because everybody is interested in the outcome part, right? Now, if we see from a long-term return perspective, say the index data is available from 1st of April 2005. So, from April 2005 till 31st of October, even if I say that most recent one, the index has delivered more than 20% return at a standard deviation, which is roughly 22% annualized standard deviation. And if I compare it with Nifty 50 or Nifty 200 or Nifty 100, all of them have delivered return, CAGR return in the range of 13.5 to 15%.
Correct.
So close to 5.5, 6% alpha at a standard deviation, which is very similar. Like Nifty 50 standard deviation for last 19.5 years is roughly 21%.
Correct.
So significantly higher alpha, at the same time almost similar standard deviation is what the strategy has delivered. Now this may be a very long-term return, because people might say that my investment horizon may not be 19 years. Normally the investment horizon are in the range of 3-year, 5-year. So even if we see the daily rolling 5-year or a 3-year return, now let me kind of also explain that why I'm saying this daily return is that it actually covers the entire market cycle that markets have seen over these 19 years. When I say daily rolling 3-year return, which means if the index data is available from 1st of April 2005, the first 3 year it completed on 1st of April 2008, then 2nd of April 2008, then 3rd of April 2008. Likewise, there are close to 4,100 observations to be kind of analyzed. In fact, more than 4,100 observations. And if we compare it with the broad market like a Nifty 50, momentum as a strategy has outperformed Nifty 50 approximately 84% times. And not only that, if you see the average outperformance of those 84 observations is approximately 7%. Now, even if we see the 16% time when it has underperformed Nifty 50, that average underperformance is around -2% only. Which means as a strategy, it is actually giving you better upside, at the same time, better downside. And that is why if you see from a long-term perspective, if we talk about a beta of say last 5 years, it is less than 1. significantly higher return at a beta which is less than Nifty 50. I mean, this is what momentum presents to the market.
Right, and I was looking at this data almost 1 year back, last Diwali, I remember, and I came across a research paper from IIM Ahmedabad, and there were all these factors analyzed for the last 25 years. And when I saw that momentum has consistently beaten and generated the maximum alpha, we almost started looking for momentum funds and started allocating our clients in those momentum funds. That has given us good result over the last 1.5 year. So it's really interesting, and it contradicts the traditional view, where traditional view is when the stock is going down, then you should start going overweight on it. And when the stock is going up, people start cutting down their exposure. But it contradicts that view.
If frankly speaking, it actually doesn't contradict. The general mindset is that if a stock has started showing signs of improvement and it started moving, it should move to a certain extent, and you have to catch that movement.
Correct.
That is what exactly momentum does, without any discretionary bias, without any human bias. And because of that, if you see, because of this defined discipline process, so far it has been a very, very successful strategy.
Sure. And since you said that it's a very high churn strategy,
Yeah.
every 6 months is almost 100%, 50% churn rate that's there in the portfolio.
Yeah.
And do you think, as an investing in an index fund or an ETF, it becomes a very tax efficient strategy for individual investors? Because if I want to replicate this index strategy in my own stocks portfolio, I'll have to pay capital gains tax on every churn that I do.
Correct.
So does it really make sense, and it becomes very tax efficient investing into a high churn strategy which is replicating an index?
Now, if you see, anyways, mutual fund structures are actually very tax efficient, because the scheme itself is exempted from any capital gains tax incidence.
Correct.
Which means whatever buying and selling is happening within the scheme is all tax free, right? Having said that, if you talk about particularly momentum strategy, where I said that every time rebalancing happens, which is twice the year, every time rebalancing happens, approximately 50% of the stocks move out and 50% stocks again then come in. So on an annualized basis, this 50 plus 50 becomes a close to 100% kind of portfolio turnover ratio. Now imagine a situation, you are managing it on your own, which means every time you are selling all those stocks, you are doing some profit booking where you are actually paying a short-term capital gains tax. Might be because these stocks might have entered only 6 months back. There is a possibility, right? Where the tax rates are as high as 20%. Even in the long term, they are still high at 12.5%. So that tax incidence will eat away a part of your return, and that will not get compounded.
Correct.
Whenever you are investing for a 5-year period, the taxation that goes on an annualized basis also kind of miss out on the compounding effect that a mutual fund will deliver to you. Secondly, from an aspect of dividend, now if you're holding all these stocks at your individual portfolio level, all the dividend that will keep on receiving will be charged at the marginal tax rates. Whereas under the mutual fund structure, it is actually tax exempted. Now, whatever tax that you're paying is on the gains that you have made at a scheme level. And whenever we are suggesting these momentum strategies, or for that matter, any factor strategy, we always say that you please come with an investment horizon of 3 year and 5 year. So essentially, you are paying only the long-term capital gains tax, which is 12.5%. So it is actually
you're also not paying every year.
Yes, you are actually making a lot of tax efficiency in your portfolio with these strategies.
And as wealth managers, we also come across a lot of small cases, PMS, based on momentum strategies, factor-based strategies. But my first point is to analyze the transaction cost and the capital gains cost.
Sure.
That's coming on the portfolio. And when you take into account, they don't look much attractive than mutual funds or index funds.
Sure.
And you also manage and you also look after the hybrid strategy for the AMC. And we very much like multi-asset balance advantage funds, because they provide a very stable return profile, and they are like an all-weather funds.
Sure.
And your funds have done really well in the hybrid category. So what is the investment strategy that you follow at UTI, particularly on the asset allocation side on the multi-asset fund and the balance advantage fund.
Right. Now, if you see the entire hybrid space, right, the essence of any hybrid scheme is that it should allow you to participate in the rally of equity, and it should enable you protection during the falling scenarios of the equity, right? That's what is the objective of any hybrid strategy, right? To kind of let you participate at the same time to offer you protection. That's why a mix is generally between equity and fixed income in a balance advantage kind of a strategy, whereas in multi-asset there is one more element which is gold, which also takes care as a hedging property.
Correct.
Now we'll discuss these two as individually. Now let me just put the multi-asset part first. When we say multi-asset, right, multi-asset, which means combination of two or more asset classes under one umbrella, under one scheme, where all these asset classes have to play their complementary role in your overall portfolio returns. In that, particularly if you see the broader asset classes that is available is equity, fixed income, and gold. Now all these asset classes have their specific role to play. Equity for the return generation, fixed income for stability, at the same time regular income, and commodities particularly for the hedging properties, which is hedge against inflation in long term, hedge against currency depreciation, and to support your portfolio during periods of economic uncertainty or any sort of uncertainty. So these are the three asset classes with their complementary roles. Now, if you combine them in a manner that it generates return across all market conditions, is what is expected from a multi-asset kind of a strategy. Now, the way we position multi-asset strategy is it is a strategy that will endeavor to deliver you returns like equity. At the same time, the volatility will be lower, which means a better risk-adjusted return. We are not saying that it will deliver you return higher than equity or lower than equity. What we are saying is that it will try to deliver you returns which are closer to equity at a much lower standard deviation. Now, this is actually a big claim that I'm making. And for that, I need to do three things right, and that too simultaneously right, which is right allocation to asset classes, right timing in terms of reallocation between these asset classes, and right selection of securities within each asset class. Now, for all of this, ultimately, this is an actively managed scheme where the discretion will be applied. Sometimes those discretions will be in your favor, sometimes it may go against you, right? So to eliminate that human biasness, what we have done is that we have implemented a proprietary financial model into the multi-asset and BAF structure, and that proprietary financial model using certain market factors will identify whether the markets are favorable, reasonable, expensive, and ultimately that decides on the allocation to equities. Now, particularly if we talk about multi-asset, there is a model. The model is actually in two parts, where the first part of the model decides on allocation to equities, which will be in the range of 40% to 80%. And the allocation to equity will be decided on the basis of four factors, which is Nifty 1 year forward P, Nifty 12 month trailing PB, the dividend yield of Nifty 50, and the yield gap between Nifty 50 and the 10-year GSEC. That Correct. Out of these four factors, two are positively correlated and two are negatively correlated. Like P and PB are negatively correlated. If higher P and higher PB means markets are expensive, you should cut down your exposure to equity. At the same time, the yield gap and dividend yield, higher the better. If those are in your favor, you should actually increase your equity exposure.
There's equal weighted exposure?
No. If you talk about these four factors, they are not equal weighted. The weight to those factors are automatically assigned using linear regression method. Okay. So we try to do linear regression, in fact, trying all the optimal combination. Correct. And ultimately it takes its shape. I mean, the factor which is more relevant takes a higher weight, and the factor which is less relevant takes a lower weight. So it automatically uses that linear regression, automatically uses and identifies or assign weights to these factors so that you get an equity score, and that ultimately decides the allocation to equity in the range 40 to 80%. But having said that, the scheme will always be an equity oriented scheme. So in case my model suggests me an equity allocation which is less than 65%, the balance will be taken via arbitrage. But we always maintain an equity taxation.
Correct.
Now, just to kind of add to the second part of the model, if you see from a gold perspective, most of the other multi-asset schemes are largely where the gold is either fixed or gold is at the discretion. In our case, we have also implemented a model which actually decides the allocation to gold between 10 to 25%. That is gold to equity ratio, which is gold 10 gram price divided by Nifty 50 TRI. It actually identifies the relative valuation of gold in terms of equity. So if the gold to equity ratio is on a lower side, the exposure to equity is the exposure to gold is higher, and if it is on the higher side, the exposure to gold is lower, subject to the minimum requirement of 10% that we have to keep.
Ranges between 10 to 25%.
Yes. Similarly, if you see in the BAF category, because there is no gold, we actually tries to play only the first part of the model, which is allocation to equity, and the balancing or the residual part goes to the fixed income.
Understood. And particularly from the current markets, if I just exclude the last one and a half month, and prior to that, since March 23, we have just seen an upside rally in the market. And recently we have seen some downside. What are the factors that you think that have contributed to this downside? We always say that you should be you can expect downside at any moment in equity markets, and that's why your investment horizon should be long. But what are the key factors in the recent one and a half month that have contributed to this downside, and how does liquidity and sentiments play to this particular market movement?
Now, actually, that's a very tough question that you've asked me. So particularly there are changes which are on the all the fronts. In terms of valuation, if we see for last 1.5 years, the valuations have actually gone to another level only, right? When we see large caps, mid caps and small cap, in fact, mid caps and small caps, if we compare them from their long-term averages, they were actually trading one standard deviation above their long-term averages. Whereas between large cap, mid cap and small cap, large caps were also expensive, but comparatively they were comfortable when it comes to mid caps and small cap. So valuation is one factor that has played out, because ultimately it cannot be insane valuations across all through, right? Some way the mean reversion has to happen, the valuations has to be moderated. So that is the one trigger that I see. The second trigger is also on account of certain sentiments, right? If you see that China sentiment that actually played in the first phase of where the fall actually started, where it was anticipated that the money is moving to China. I mean, that can be a very small factor, but that actually played out, and that sentiment got carried forward, right? Now, with respect to the current market environment, if you see, there is no change in the macro level as such. Everything remains the same. The demographic advantage that we were talking about, the stable government at the center we were talking about, the consumption pattern that we were talking about, everything remains the same. Now, if we particularly talk about this consumption thing, this consumption story is not new, that have just come up. It was actually for last 2 to 3 quarters where everybody was anticipating that there can be expected slowdown, all of that, and then recently few of the companies reduced their capex budget and all of that, and ultimately sentiment also played out. So it is a combination of different triggers that has actually been kind of played out, and the kind of fall that we have seen. Particularly, if you see, if you ask me, this is a healthy thing, right? Ultimately, it allowed a lot of people who were actually sitting sideways to start entering into the market. So we have to think it from an opportunity perspective. Absolutely. In fact, if we see as a fund house, we were giving this call for last almost 6-7 months, that if you have made a decent return in your mid and small cap portfolios, it is a time that you switch book profit and switch to safer categories like hybrid, which is multi-asset and BAF. That has actually played out.
And I was speaking to actually Mr. Vetri Subramaniam around in January or February. And he asked me what's the difference between early or being wrong. There is no difference, because people have been giving these calls that markets, there are certain pockets of overvaluation. You should start booking some profits and move towards either hybrid or large cap space.
True.
And particularly from this, how the things have played out in the last 1.5 months. What was your asset allocation 1.5 months back in your BAF and multi-asset fund, and what is it now at this moment?
So if we see both against BAF and MAF, our allocation to equity was on the lower side. Now, if I give you an example of MAF, my exposure in August and September end was as low as roughly 47%. So that was on the lower side, because my lower band itself is 40%. So that was on a very lower side. while my allocation to gold was roughly 15%, 13 to 15%, and remaining was arbitrage as well as the fixed income. Now, very recently, we got a trigger where we have increased our exposure from 47 to 53%. Because of the recent fall, the valuations have moderated a bit, and that has triggered me to kind of increase my equity allocation. And the best part is that it is all non-discretionary. I mean, it is all non-discretionary because it is all number-driven, decided by a proprietary financial model that we have put in place. Now, if you see the recent performance of multi-asset for that matter, we have implemented this model on the scheme on 1st of April 2022. And since then, if you see the kind of returns that we have delivered, it is not about a good return or a bad return. It is about showing a consistent return, a return which is closer to equity at a lower standard deviation. And for example, if in case of multi-asset, my equity proxy is BSE 200. And if we go and check month on month based on last 1 year return of multi-asset, and if we compare it with BSE 200, across last 17, 18, 19 months, we have delivered returns very close to BSE 200 at equity exposure, which is close to 60-65%. The standard deviation is also significantly lower than BSE 200. So that's what the entire objective of multi-asset, right? To generate returns like equity at a standard deviation which is less than equity, so that on a risk-adjusted return, on a risk-adjusted basis, you generate an optimal return.
Absolutely. And thank you so much, Ankit, for answering all our questions and so beautifully explaining both on the passive side and on the hybrid side. Just wanted from you to throw some light on your AMC. UTI is the oldest mutual fund house in the country. So if you can throw some light on your AMC and some of the best practices that you follow.
See, when it comes to mutual fund, and whenever somebody looks to kind of invest their hard-earned money, the first thing that comes to their mind is the trust, right? And with our vast experience and the legacy that we kind of bring to the table of, say, more than 35 years of wealth management, we have created that trust in the industry, right? With our processes, with our experience, and with a proper people management, we have actually curated a structure where we always think investor first. So that is the approach we all work with. Right from top to bottom, we follow the same principle that the objective is to kind of build an environment where the smallest person, or for that matter, the smallest section of the society at the bottom of the pyramid, should also be comfortable and equipped enough to come and invest in a scheme and can generate their wealth, and it is ultimately a wealth creation journey for them, right? So we strongly follow that the ethos are from the top, that we should think from a perspective that everybody is taken care of in terms of their wealth creation journey. Having said that, we have strong processes in place, a robust risk management system, a robust compliance team which actually monitors each and every aspect, every action on ours that we do on a daily basis, so that at any point of time there should not be any deviation from the regulation that regulator has put in the interest of unit holders. So that is the principle that we follow, and that is followed across the board.
Thank you so much, Ankit, and thank you for coming here today.
Thank you.
And thank you everyone for tuning in for such an interesting session. And we look forward to doing more such sessions with you and your team in future. Thank you. Thank you everyone.